but hello, everybody. Welcome. So glad you can make it today. Again, thank you, everybody, for renaming yourself with your organization. It's nice to see five organizations here with us from different parts of the world. Um, I know I've met all of you, but just to introduce again, my name is Ruod. I'm joining you from Manila. I'm the community choreographer here at Pollinate Impact, which means I get to design spaces like this one where we bring the right people, tools, and conversations together. If we can please bring up the slide, please. Just want to let you know that, since you're already part of the Pollinate Impact community, one of the things that we'd love to ask is if you know other incubators or accelerators who should have access to spaces and toolkit sessions like this one, please send them our way. If we can please bring up the slide. The ecosystem is really stronger when more of us are learning and growing together. And honestly, the organizations in your network are probably navigating the same challenges you are. So why not bring them into the network so that we can all help each other? And as a little thank you from us, for every successful referral you make, you'll receive 10% off your annual membership fee. So the more you share, the more you save while helping grow a community that benefits everyone. We got the slides up, please. Azan, Fabia. There, but we will be sharing the referral link on the chat, and you're free to pass it along as well. All right, we'll be sharing the QR code in a bit once the slide comes in, but just to get us to what we're going to talk about today, one of the most common challenges we hear from incubators and accelerators is that entrepreneurs are building promising solutions, but getting the right capital at the right time can feel incredibly difficult. Sometimes the issue isn't that funding doesn't exist. It's that, one, it could be too expensive, it could be too complex to access, too time consuming to navigate, or simply not designed for the realities of the impact enterprises that we are currently supporting. Many ventures get stuck in the missing middle, as we like to call it, too advanced for grants, but not yet ready for traditional investors. And as program managers, investment teams, as organizations here, you're often the ones helping them make sense of a rather fragmented and overwhelming funding landscape. So today we're focusing on a question that matters deeply to many of us. How do we make capital not just available, but genuinely accessible? Which brings us to today's session, the Pollinators Toolkit, Unlocking Affordable and Accessible Capital with LendForGood and Vula. We're joined by two organizations working on highly complementary parts of this challenge. LendForGood is helping enterprises access affordable, crowd-powered debt financing, allowing them to raise growth capital without giving up equity too early. Vula is making it easier for small to medium enterprises to identify, apply for, and access the right funding opportunities, while also helping funders and ecosystem organizations deploy capital more efficiently. Together, these platforms offer a powerful reminder that improving access to capital is about more than putting more money into the ecosystem. It's also about building better pathways so the right capital can reach the right enterprises at the right time. Said right like 3 times. If you support entrepreneurs and have ever thought there has to be a better way to connect our ventures to funding, or our funders spend too much time chasing the wrong opportunities, or even how do we help enterprises access capital without taking on unsuitable terms, then today's session is very much for you. So our agenda for today is this welcome. You'll have a quick check-in with Tess, and then we'll learn more about LendForGood and some experiences with LendForGood. Then we'll pass it on to Vula, take us through Vula, and then we'll open it up for questions and open discussion for everybody to get to know more of the platforms together. So my hope is really that today you leave not only inspired, but with practical tools and partnerships that can help your entrepreneurs spend less time searching for capital and more time building solutions that matter. Because when capital becomes more affordable and more accessible, more impact enterprises get the chance to grow. So let's get into our session today. So I'll pass it on to Tess to take us through our check-in. So Tess.
Fantastic. Thanks so much, Rod. Appreciate being here. Hi, everyone. My name is Tess, based out of Nairobi, Kenya, for anyone who does not know who I am. For the next 5 minutes, each of you is going to be in a breakout room with two other people. Well, we read the session description, we saw the calendar invite. Rod has given us a good understanding of why we are here. I'm going to give all of you a chance to discuss this with the person you're going to be in the breakout room with. And the question you're going to be answering, I'm just going to drop it in the chat. Of course, you'll introduce yourself, you know where you come from, your organization, your role, and then what are you hoping to understand more from today's session, and how do you hope to apply it? So you and the person you will be in the breakout room with, that's kind of what you'll discuss. And then after 5 minutes, we'll come back and we'll kind of share with the group what it is we've discussed in our breakout rooms. So they are going to be opening in the next couple of seconds, hopefully. Happy chatting, happy conversing, and I hope that you make a new connection and hopefully find some similarities in why you're all in today's session. So, hey, Rod.
Hello. Hi.
Oh, the breakout rooms are not closed yet. Okay.
They're they're easing in the 60 seconds.
Mm,
So funny. So I hope it doesn't come yet. Oh, later. Welcome back.
cool.
Welcome back. I'm just waiting for the others to come back from their breakout rooms. Conversations must be good, Tess, because they don't want to come back yet to the, to the main plenary.
Let's hope so.
We have two more rooms that we're waiting on. I think there's 10 more seconds.
Yeah, it's about 5 now.
Great. Welcome back, everybody. Had a good time getting to know others in the room. Right. Tess, any does anybody want to share what they talked about in their check-in group? Any kind of insights, anything that they're excited to learn today's session?
We were mostly just kind of saying hello and where we're based. I have to admit, I was a little reluctant to say too much because it would just preempt what I'm going to present anyway.
Oh, I
So
understand.
yeah.
All right, thanks, Tom. Anybody else? Anything that stood out for you? I mean, quickly in our group, I think one of the things that Astu mentioned was that she was really excited to kind of understand how the platforms work, what the process looks like, and what opportunities, like exciting opportunities, she can learn from the platforms, how best to kind of utilize it for her portfolio. So I think that's something that me also, I'm personally excited to hear, so that hopefully it can be helpful for the rest of the group here. Okay, one last call in case anybody still wants to share any burning insights or answers from the check-in that they'd like to share. Going once, going twice. All right. Okay, well, thank you, everybody. And thanks, Tess, for going through the check-in with us. That was nice to get to know others in the group. I will now turn it over to just quickly introduce both of our guests for today. I mean, the ones who will introduce their platforms for today. And then we have another guest with us sharing their experience with LendForGood. So I'll give a little bit of time for them to quickly introduce themselves, and then we'll get into the platform demo. So I'll go first with Tom. Tom, if you'd like to introduce yourself.
Well, hi everyone. My name's Tom. I'm one of the co-founders of LendForGood and Chief Impact Officer. And my work particularly is focused on partnering with entrepreneur support organizations and intermediaries like you guys. And so, but before I get into how LendForGood works, I want to kind of do a quick story of how I got to this point, I guess, and where the inspiration came from. Because I've always been in the business of helping people start things. I founded a youth-focused organization while I was at university and led that for 8 years. And as part of that organization, opened the first co-working space in Sydney, a space called Square One initially, and which operated for almost 20 years, sadly closing down just a few years ago. But the organization that I founded continues now and is 26 years old, so long past my time there. After that, I spent time in the US, initially working for an organization called Ashoka, which is one of the world's leading kind of networks of social entrepreneurs. And I was the first digital communications director there. And my task was essentially to think about how digital communications could help achieve or inspire an everyone a change maker world. What are the ways in which we could help more people get involved in the work of making change and being change makers in all the various forms that takes. Then I moved and spent 2 years living in San Francisco, working in Silicon Valley, mostly for an organization called Hope Lab, which was kind of like a venture studio for impact tech projects. And it was not so much Hope Lab, but just the whole experience of the Bay Area, where I felt like I was experiencing what a pro-innovation ecosystem looks and feels like for the first time in my life. And it was that experience that really inspired me to start Some Good at that time, now 16 years ago. Initially as one of the first impact-focused crowdfunding platforms in the world, specifically to fill this gap I suddenly realized was there. And it's one of those examples of not even kind of understanding my own experiences. I'd worked very hard in founding VibeWire, the nonprofit, to raise money to do interesting, innovative things, opening the co-working space, doing online events, in 2005, 4 and so on, what we now call, I guess, virtual summits, and so on, and various other, relatively innovative projects. And part of our challenge was, it wasn't just that we hadn't done them before, but in many cases, no one had done them before. So we couldn't kind of share a proven impact model to potential supporters or philanthropists. What I realized in San Francisco was that philanthropy in Australia essentially had the characteristics where there was lots of VC style money, large chunks of other people's money being invested professionally or given away professionally, and very little angel equivalent money. And I began to realize the really important role that early support plays in helping new ideas get off the ground and the whole infrastructure around that. And so Start Some Good was inspired by and dedicated to providing some of that same support to people at that very idea stage. Over the 16 years Start Some Good's been operating, it's evolved into much more of an intermediary, probably much more similar to many of you. While it still has a crowdfunding platform, its bread and butter is running between 8 and 12 accelerator type programs each year on behalf of partners who are city governments or foundations or corporates, built around particular criteria, like a circular economy startup in South Australia or a refugee founders accelerator program. And so over this time, I have co-hosted something in the order of 100 accelerators or pre-accelerator, go-to-market, various programs, and have worked closely with almost 1,000 entrepreneurs. And what I've seen again and again, which began to feel very frustrating to me, is how hard it is for many of them to then progress. And that so many of them get stuck. What we see is a very high survival rate for people who go through our programs. They're often very driven, very resilient. They stick with it. They don't quit easily. They're there for much more than just money. They want to support their community. They want to uplift people who need help. They want to, provide something that's better than the status quo. But often while they don't quit, they get stuck. Very, very few of them succeed in scaling. And what I realized was that what's holding them back is this thing that tends to get called globally the missing middle, which was reflecting much the same dynamic that I had seen before with philanthropy, that there's lots of money, but it's clustered at the latter stage, and far too little money at the earlier stage in that kind of angel investment type stage. It's just a little bit further along. So where Start Some Good was working at the very beginning, there is more support in Australia, maybe not true in all of your countries, but in most countries I've visited, and I've worked in quite a few, there's so much more support at the very beginning than there was 15 years ago, at least, 16 years ago when I started Start Some Good, in terms of grant programs, universities helping students start initiatives, the existence of the fact that you guys exist shows that it's easier now than it was 15 years ago. Many of those pieces that didn't used to exist now do, but the gap that we see, this missing middle, is kind of the post-launch stage where something is working, but it's so hard to access that capital to double down on or to invest in the thing that's working, to take that next step in terms of equipment or moving to a new market or stepping from B to C to B to B, moving with bigger clients. But there's often a certain amount of investment or operating capital needed to make those steps that people really struggle to access. So I'm just going to quickly run through some slides. Sorry, and I should give some background. I've known Cameron for a really long time, and he'll talk in a little bit. But LendForGood was born essentially out of us catching up for the first time in a little while, maybe 8 years ago now, 7 years ago at least, and me talking about the stuff we were doing at Start Some Good and this frustrating challenge I was seeing that, so many of them were really struggling post our program. We were getting them launched, but then they were having trouble to progress from there. Cameron had seen something similar and had co-founded something that was very new then called Red Hat Impact. And they were working to support companies through that exact stage, social enterprises, helping them design particularly loans that a community of lenders that they were cultivating were supporting. So a syndication model where they were helping find the opportunity and develop the structure, do the due diligence on the deal, make sure it's a good fit for the instrument, and then presenting it to what at the time was basically an email list of people they'd built that they thought would be ready to support that. And I thought, as soon as I heard that, I thought, that's brilliant. That's exactly what we need. But what you need is a platform under that to make that more efficient. That sounds very labor intensive what you're doing, and there's just one of you. And we kind of got talking to how could we help Red Hat Impact do what they do, but do more of it, do it more efficiently. But in so doing, could we build something that lots of people could use? And I'm just going to quickly, sorry, this is probably taking a little too long, but I'll speed up now. But I want to quickly just kind of run you through what we came up with, essentially. Can I share a couple of slides?
Yes, please go ahead.
Yep, here we go. So both of us thought, that the key, and our co-founding teams thought that the key was that we needed to democratize impact investment in order to find that better support. My experience in supporting communities, not just traditional large, filling that kind of earlier stage gap. And so this missing middle that we see is a global problem. And it's kind of the gap between the two great sources of energy in business for good. One is the actual startups. They're growing everywhere thanks to the work of people like you guys. And what we see in our programs is incredible businesses with really great models that will make a real difference to their community environment. At the same time, we're all constantly hearing about the growth of impact investing, and that's a true fact. $1.5 trillion was invested in impact investment funds just last year, according to GIN, the Global Impact Investment Network. But there's now over $2.5 trillion in those funds. And what does that tell us? They're not deploying it. The money is banking up in those funds. And that's because of the gap between these two halves. All the promising startups on the one side, all the money that's clustered at the latter stage on the other side. And as a result, no one's really getting what they need. We have everything we need. We have the ideas and the innovation. We have the capital. But the people with the capital can't find the deals they want, and the people with the enterprises can't find the capital they want. So even though we have everything we need, no one has what they need for the ecosystem to grow. And I used to think this was about risk, but what I've learned is it's really about just the economic model of those funds, that the way they do business is very traditional. They might be trying to achieve something that's new, genuine impact through investing, but the way they're going about their business tends to be very traditional in the way they approach due diligence and is very expensive. And the need to verify impact just adds another layer of cost on top of that due diligence cost. And so the reason we're not getting those earlier deals in the ecosystem we need is less about the risk profile of those deals and more just about the size of those deals, that they're too small for most of the funds to even look at. They just don't fit their actual economic model. And so what we came up with was, once again, the idea that while they won't fit potentially the economic model of those large investors, there's a whole nother world of potential supporters out there, which is all of us. And at the same time, there's larger investors, but who are struggling to find the specificity of impact that they want to invest in that would make them willing to open up to new ideas. And thirdly, we wanted to reduce the cost of due diligence by sharing the incredible work that people like you are already doing. You're already in the business of identifying potential, of clarifying, pathways to growth for the enterprises in your ecosystems. And so instead of them leaving your, kind of moving on from you to someone new and starting from scratch, we want to help leverage that asset that you have, your pattern recognition, your relationships, your understanding of who's trustworthy, what's likely to succeed. And so on our platform, people can find a whole variety of different deals. All of them have to be linked to at least one sustainable development goal. But as you would know, I'm sure that's pretty broad once you look across those 17 goals and the 200 indicators under them. But crucially, it's not just a typical crowdfunding platform where an enterprise that needs money comes along and builds a crowdfunding campaign. It's actually a syndication platform. And so it doesn't just have borrowers, the companies that need the money, but crucially, we work with intermediaries, and they're entrepreneur support organizations like you guys, incubators, accelerators, early stage investment networks. And the only way those borrowers can get their loan listed or their deal listed on LendForGood is via the approval and endorsement of one of those intermediary organizations. And then using our platform, we connect you with our growing community of impact lenders, and we handle a lot of the laborious, busy work that makes these deals so complicated to put together and so expensive, typically. And so this is essentially a three-sided marketplace. And it's about working together. It's exactly, some of the things that have come up and been mentioned already, that it's through partnership that we can kind of plug together all the different pieces that we're all doing already, all the incredible work you're already doing, and create that capital pathway. We know that debt, let alone online syndicated debt, is not going to be the right thing for every company at every moment. But we just want to add another option. Right now, there tend to be too few options that even exist. And so we want to be another option. But the best way for an enterprise to know if it's the right option is to work with someone like you. And so it's where we really want to shine that spotlight on and empower intermediaries like you to do what you're already doing better by you being able to offer this extra pathway. But in providing that endorsement, also giving investors the confidence that they need to invest. And so, look, there's a lot of text on this slide, and I've spent too much time already, and I'm happy to share this with anyone who's interested afterwards. But essentially, we're trying to solve a lot of these barriers that create the missing middle because people find it hard to get to a level of sufficient confidence, and the endorsement model helps create that greater confidence. We do accelerated kind of deal terms with templated contracts and shared infrastructure. We take care of a lot of the busy work in terms of signing people up to contracts, moving the money around. And so there's greater efficiency, greater transparency and trust, and ultimately, the most important thing, greater access to capital for the enterprises that we believe in and that we want to see grow because they're making a difference in the world. And so we've got 22 intermediaries in 9 countries signed up so far, including people like Renewables in Africa and Thuo Fund in Kenya, and Red Hat Impact, the joint venture partner we began with, who have also supported a number of enterprises in Africa so far, which is why Cam's joined us today to talk a little bit from the intermediary perspective, how they use the platform. And it's thanks to them that we've had the honor of hosting amazing enterprises doing important work like alternative proteins in Cambodia, creating jobs through a laundry social enterprise in Australia, electric motorcycles in Benin, and tuna circular economy through the tuna recycling in Indonesia. But how would people otherwise have kind of enough confidence or know enough to actually move their money into these emerging markets? And that's the important role that partners like you play. And so I thought about showing you kind of the back end of the website, but it's a series of forms, really. It's not very sexy. And I just thought maybe this is a better way of just displaying it. Essentially, you're working with different enterprises, and one of them has a short-term growth capital need. You guys work together to agree on what you think are the right terms that suit their circumstances, and then ultimately upload those terms onto LendForGood. And then we launch the campaign. We share with our existing community of lenders. You guys share with your communities, we hope, and ultimately it receives enough interest and subscription to meet its minimum target, at which point we facilitate the money transfer while at the same time handling all the contracting, all the know your customer, anti-money laundering checks, verifying identity, and so on. Ultimately, then we hope the business repays, builds its community, and everyone wins. The enterprise is able to find the capital they need. You guys get to help your clients and your portfolios company grow. Lenders get impact-led returns. The world benefits from these, solutions and positive companies scaling and making progress in the SCGs. And so it's all about collaboration for us. Just to reiterate the final points, and then I'll get off and give Cam a chance to talk. Only approved intermediaries are able to list loans on LendForGood. We don't set deal terms. We don't decide who is or isn't the right fit. You get to decide what's right for you, what you're willing to endorse, what your community would be most interested in seeing. The idea is that we want to give lenders the kind of choice they would typically get on a crowdfunding platform, but the kind of confidence they typically get investing through a fund, knowing that they're still able to follow the expertise of an expert and a credible partner in the sector, which is you guys. And it gives intermediaries like you a unique opportunity to demonstrate your leadership, grow an investor community attached to you and your focus, and to help the enterprises you care about succeed. So I'll stop there. I've probably talked for too long. I'm sorry about that.
Oh, thank you, Tom. That was really great. I think it's really interesting to learn more about LendForGood. And if you all have any questions, you can put it on the chat. We will take all questions after both platforms have kind of demonstrated and talked about their own platforms. But for now, I'd like to welcome Cam to kind of talk about their experience working with LendForGood and talk a little bit about Red Hat Impact. So, Cam, over to you.
Hi, everyone. I think the things that I'll just focus on in a few minutes is what we, as Tom said, we used to do this in a very non-transparent and non-visible way. We'd send emails and PDFs to like people and we'd do investment, whatever. I think the advantage for us of using a LendForGood is we have a public-facing campaign page that can communicate what we're doing and can show the portfolio that we have of the enterprises that we support. And as an intermediary, what we then build is a following from lenders and people to go, Red Hat Impact has another deal. And because I think trust, it's all about trust, right? And so I think as intermediaries, we are kind of providing the trust mark to lenders and potential lenders that this borrower is someone we believe in. We've had a look, we've got under the hood, we've looked at the unit economics, we've looked at the financials, we've done a risk assessment, and we've given all that information to you. We've put it up publicly, and we construct that with the borrower. It helps them kind of learn and understand. But, so what we kind of do is a bit one-off with them, but with the community, it's kind of like the benefit accrues over time. Like the more we do, the more people see the kinds of borrowers we work with, and they're like, Red Hat Impact has another deal. Great, we're interested in that because Red Hat Impact they do interesting stuff, right? And so I think, it kind of bypasses some of the kind of crowdfunding stuff where a borrower comes and goes. Us as intermediaries are kind of the connection point of the platform. And what enables us to do is to focus on the work we want to do, which is to help these enterprises grow, help them access capital. What we don't have to spend our time doing is chasing up money, coming up with loan agreements and like contracting people. And, LendForGood collects all the money from the lenders in the syndicate and sends it to the borrower, and the borrower repays. And like, we don't have to touch any of that, right? We can just focus on supporting the borrower to use that money effectively and to have impact. And so for us, it's a bit of a no-brainer in the sense of what are we good at and what do we want to do? We don't want to be we don't want to be a bank. We don't want to be a finance organization. We want to work with great founders and enterprises and help them grow. And where debt capital is the right tool, we can use this platform that can take care of so much of the busy work for us, but in a very public way. And the work that we do is public, it's shared, and it builds, and we get to support other intermediaries and help them learn about using the platform and stuff as well. But it's a collaborative thing and a public thing and a transparent thing, as opposed to we could have continued doing what we were doing. It would have been a lot more work. It would have been a lot more difficult to attract lenders because it's not public and not transparent. Using something like LendForGood has really helped us, I guess, do it a lot faster and focus on what we're good at, which is growing impact enterprises and supporting founders, not having to get stuck in the busy work of writing loans and managing loans, right? Like that's the benefit for us. I'll stop there. Happy to answer any questions.
All right. Thanks so much, Cam. Thank you for sharing your experience. And thanks, Tom, for sharing about LendForGood. We have a few questions already. I'm excited to get into it later. But before we do that, I'll transition over to Kevin from Vula to now share more about Vula, the platform, and also just a little bit about how people can also utilize it. So, Kevin, over to you.
Thanks. This is quite an interesting day for us because it almost feels like we spent the last, the evening last night sharing notes with LendForGood. We have so many areas of alignment here that it's actually quite crazy to me and mind-blowing. So anyway, Kevin Correa is my name, head of East Africa for Vula. You can just share this. I believe you can see my screen.
Yes.
Brilliant. Head of East Africa for Vula. And what is Vula? Vula is a network of funds and funds of funds that deploy capital to SMEs in Africa. We have a footprint in 14 African countries, especially concentrated around Eastern and Southern Africa. And we work across the capital stack. So that's debt, grants, and equity. Now, as I run through these slides, you'll see why I was saying it's quite remarkable about the similarities between our two companies. It's the same thing that Tom spoke about, right? We have SMEs, we have investors or funders, and we have aggregators, or what he called intermediaries. And it's the same kind of setup we have here, especially in Kenya and the rest of East Africa, where for SMEs, it's very difficult to find relevant funding. SMEs jump from funder to funder and waste time applying. As well, for funders, it's very expensive to keep on rejecting all these SMEs because they simply don't fit their criteria or investment thesis or mandate. And of course, for ESOs, and ESO here could mean accelerators and incubators as well. You spend a lot of time talking about access to finance, access to capital in all these programs, but the reality is how many ESOs actually enable their SMEs to get funded? It's not that many, to be honest, even though most of them say that they're doing that, right? Now, what we're building here was based on one of the insights we've discovered from building such a network. We have a general bird's eye view of the funding ecosystem across Africa, right? And historically, up until now, we've been treating investor readiness as this goalpost or finite line that a founder needs to cross. Then you're considered investable or creditworthy. But the reality is it depends. Creditworthy is in the eye of the lender. Investment ready is in the eye of the investor, right? And it is very difficult, as all of you know, to keep up with all the requirements from all these different financial institutions, from all these lenders, from all these VCs, impact investors, and so on and so forth. So we built the technology to support the network and not the other way around. So how does that work? We have a bunch of SMEs here, of course, being guided or directed by the supporting ESOs or accelerators who have a wide variety of documents and their data sources, be it their pitch decks, their financials, their bank statements. And what does an ESO or accelerator do? They'll assess all these documents and then probably hear either in the open web or from a direct link to an investor that we're looking for such a company that fits a specific kind of profile. Now, it's your work still to go back and assess all these documents again. And ultimately, you waste a lot of time in this chaos of hundreds upon hundreds of pages of pitch decks, of financials and whatnot. And in the end, it is still very unlikely for your SME to get funded, right? So this is our solution. We built what we call Vula Together. And Vula Together is a platform built for ESOs, for accelerators, to enable you to upload your portfolio or your current cohort's data. And Vula will automatically assess this data against the eligibility criteria of our funding partners. That's across debt, grants, and equity. So take a bank, for example. KCB Bank is one of our partners. They're looking for companies that have collateral, they have minimum revenue requirements, they prefer companies that are profitable, they need companies that are older than 3 years. Instead of having the SME or the ESO or the association or the incubator manually going through or sifting all the documents they have to see which fits this, we do that automatically. And this is a drudge work that I think Tom mentioned earlier, that you don't need to do this anymore. Basically, we've reached a point where our technology can assess documents at scale on your behalf and automatically match your current cohort to whichever active funding products are out there, be it a lending product, a loan, be it a concessional facility, be it a grant or an equity investor. And essentially, we're aiming to save time on both sides. And this means as well, the funders within our network stop spending most of their time rejecting people who simply don't fit. If you're not a tech company that's early stage, you have potential to scale, Antler is not going to listen to you, right? But the reality is they receive thousands upon thousands of applications. So, and that is actually one of our partners. And if you look at the actual end goal of Vula for a partner like Antler or a partner like KCB Bank, for example, it would be to save time, essentially, save time and save cost. Of course, for SMEs, very straightforward. They don't want to spend time jumping from funder to funder. That I think we all know. This is actually outdated. So far with this model, we've done 8 million USD in funding. This is in Kenya, and also South Africa is a similar amount, I believe so. And yeah, so what I've described right now is the automated way of doing this at scale that we provide as an option. Now, we have some incubators, accelerators, and ESOs that are small, more boutique. They don't have the scale or numbers to require such a platform. And for that, we do the traditional manual way of, you can give us access to your data rooms with all the individual SMEs there. And we do that. We actually offer this as a service for free for the ESO. We'll go in there, check out which SMEs look good, and we assess them against the funding opportunities that we already have. And then we present these opportunities to you for you then to enable the SME to actually get it done. So as I wait for some questions, I'm going to show you a snippet of what the platform actually looks like. Don't worry, this is not a demo, but this is what you'll see. This is an SME here, and you can see their ask is around 30 million rand. We have the general information, a summary of the SME, that you can treat this as a CRM of sorts for an ESO, right? Now, it gives you a summary, it gives you the high-level services and offerings and the competitive advantage, and of course, the funding profile, including the currency. So if you're in Kenya, this would be Kenya shilling. Now, this is what the matching looks like. This particular SME has been matched to 40 different funding products across debt. I don't know if there's equity here. Yeah, this is pure debt. There's no equity, and there's been matched to one grant here. Now, Vula makes it very easy for you to see why this company is a good fit for this funding product. And additionally, if it's not, we can tell why it's not. So let me just pick one. So like this is the Rwandese SME Support Fund. We can see there's a gap here. Now, what's a gap? It's something that the business hasn't met for them to qualify for a specific funding product. So this really does, when I say it automates the drudge work, it really does automate the drudge work. This would have been you having to go through their pitch decks to see the age of the company, maybe their registration documents. But here it's identified that this business is simply too young to be eligible for this facility. Now, if you open up the gap section in detail, it goes very, very minute. We're really serious on saving time here. If you don't have collateral, if it's a no, it automatically discounts or removes all the funding products that require that collateral. If it's equity, if you're not willing to give equity, there's no need for them to see anything about any equity investments. And of course, now we're able to see which documents are missing. Let's say if you did 6 months bank statements instead of 12 months. And this is Vula together. Any questions?
Awesome. Thanks so much, Kevin. And I understand that SRC, Smart Regional Consultants, has kind of successfully used Vula as a platform for some of their incubators. Can you talk a little bit about that, if that's okay?
Yeah, SRC was one of our earliest ESO partners early last year. Before last year, Vula was built to support the funds more so. Now, when we started in Kenya, SRC was our earliest partners. They do have a very good pipeline when it comes to companies both in Nairobi, but also in the northern part of Kenya. And as well, we are working on co-designing programs for their SMEs. So we have specific, I'll just give you a hint of what we're working on here. We have some mandates. Am I still sharing my screen?
Yes, you are.
Yeah. All right, brilliant. So this is something that I want to actually replicate across the board here. We have specific mandates where funders come to us and tell us, we're really looking for high quality pipeline for these sectors. They outline for us their focus sectors, the ticket size, the revenue requirements, and so on and so forth. And we're able to work with SRC to actually attract SMEs that fit exactly this criteria. Now, what does the program look like? It would look like SRC informing the SME, for you to be a good fit for this early stage equity investment, what do you need? What does a deal room look like? Have we actually checked that you're meeting these revenue targets? Are you in the right sector? How do you present yourself to the funder? And that is just one of the ways we are working with them.
Great. Thank you. Thanks, Kevin. This is really exciting. I love both platforms and how much they can really save time and also effort for kind of all the stakeholders involved in this process, right? And I see we have a lot of really exciting questions here on the chat. So maybe I can start with Jonathan's question here to both Tom and Kevin. What's the framework and price for an ESO to engage with your platform? So what does that look like for ESOs, incubators, accelerators to actually get kind of started with both LendForGood and Vula? So I'll start with Tom and then we can go to Kevin.
So our standard pricing, and we're definitely open to, as we move into new markets and whether this is a fit, but is a listing price, and then there's a success fee based on the funds raised through the platform. And so the listing price tends to be either 1,000 or 500, depending on the size of the funds sought. And then the initial commission is 2%, but that declines over the course of the year. So it's 2% for the first $250,000 raised, then 1.5% up to $1 million, and then 1% past that. Calculated not per enterprise, but per intermediary. So if you bring repeated loans to the platform over time, the cost of capital will decline. Eventually, if you're using you're finding enough kind of use of the site, as Red Hat are the one intermediary who have reached this stage, there's also a subscription fee, which then serves to reduce the other fees. So that only becomes, you'd only move on to that at the point at which it was saving you money.
Thanks, Tom. I'll go to Kevin.
Thanks, Tom. Vula's pricing for aggregators, ESOs, accelerators, and incubators and associations is in the negative. You actually make money. If you give us high quality pipeline, especially for commercial debt, we can work on a revenue share model.
So it'll depend on what you agree on with the organization.
Exactly. We agree on the terms based on the agency and sectors that we need to source for, the ticket size, and of course the kind of debt. So say concessional debt will not carry the same rate as a typical commercial debt. So it's heavily dependent, and we do this on a case-by-case basis. Yeah.
Great.
So just one example right now, we have in Kenya for the ESOs here that are in the room, we have an unsecured debt facility for up to 300,000 Kenya shillings. And this is one of the examples that we can do a revenue share because we need volumes here. And we're targeting groups of SMEs within specific value chains. So if you have lots of SMEs, say in the livestock sector or in the agri sector in coffee, we're able to co-design very detailed eligibility criteria such that you can actually source for us. We handle everything else from the initial credit review all the way to disbursement. And for this now, we can do a revenue share.
Thanks, Kevin. And maybe a follow-up for both of you in terms of region. Like I know, Kevin, you talked about Africa. So is Vula right now available within the African region? And then for Tom, what does that also look like in terms of access for maybe Africa and Asia, since that's where the network is right now? Kevin, maybe you first, and I'll pass it on to Tom.
Yeah, we are in most Eastern and Southern African countries, with the exception of a few that you would expect, Somalia, Eritrea, Djibouti, the typical countries that you'd expect, right? And we are also in Nigeria and Ghana.
Thank you. Thanks, Kevin. Tom, or for LendForGood?
So we could be anywhere. I mean, now obviously there's also, maybe I'll weave in, there's a question about regulation here. And so there may be specific regulations where you are that also we rely on, we're providing a set of tools, but slightly different things may be allowed or not allowed with those tools depending on where you are. But as a general rule, part of what we like about debt is it is the most similar and the most global. If we're an equity platform, equity is jurisdictional, as is philanthropy. There are different philanthropy rules, different rules on who gets to do equity investment under what terms. In Australia, there's an income cap and then a certain amount you can invest each year through crowdsourced equity platforms. So you're having to do a income check on people. Debt doesn't involve any of those things. It usually sits under just contract law, which is pretty similar everywhere. So assuming that's the case, then you can use it where you are. And just to weave in another question, someone said, and Cam's already provided an answer in terms of their experience in terms of terms, but I guess the mind shift I want to get you thinking about is obviously check Vula first, and if there's already a great fit for the enterprise you're talking to, do that. Now it's more efficient and more, if the funding exists, that's great. What you often find is that there isn't quite the right thing, and I suspect you'd still find is that things don't always line up, just because of the needs of traditional investors. And we think there's huge opportunities in raising investment from people who are not investors. And that doesn't sound right at first, but if you think about, say, the philanthropy world, the vast majority of charitable contributions are not given by people who consider themselves philanthropists. It's not what they do full time. It's something that they do occasionally if they encounter the right opportunity, the right story that lights them up, inspires them, and that they want to be part of. And we think the same opportunity exists for investment. Right now, investment is just something that investors do. And we instead want to make it part of the toolkit of things that anyone who cares about our community, cares about an impact, cares about a sustainable development goal, cares about uplifting a particular community can choose to do. And much as we want to add it to your toolkit, we want to add it to the toolkit of the average middle-class person in any given country. But what that means, particularly if you're using our platform early on, is that you shouldn't be too guided by what's happened so far, because we're early as well. And while we do have an early adopter community of lenders, they're disproportionately Australian at the moment. They've been drawn by a particular part of why gender and climate are working well is because we've had great gender and climate campaigns. So if you are gender and climate, it probably will be a little bit easier. You will line up slightly better with our existing lender community. But the point is not our current lender community, it's the lender community you want to build alongside your enterprises that's relevant to your work. And that may mean a little bit more work upfront for you in cultivating that community and communicating that community. And that'll get easier over time. Like Cam mentioned, as Red Hat have done several dozen deals on the platform now, there's more and more people who are just like, we trust Red Hat Impact. We know what they're about. The last deal worked out fine, makes us feel good about the next deal. So the kind of conceptual shift is not just to work backwards from what the investors want, but to think about what the enterprise wants. Right now, impact investing inevitably is done through funds, and funds are a promise to their investors. So no matter what change or impact they set out to create, they have to work within the mandate they're given by their investors. So they're structured around the needs of investors, and then they go looking for enterprises that can fulfill those needs. And that's super inefficient, which is why what Vula's doing is super cool, because that looking for matching bid is insanely inefficient at the moment. But we want to encourage a little bit of kind of turning that around, that start with really getting focused on what does the company need. And then if that doesn't line up perfectly already, let's go looking for those investors. I bet we can find them, but it may, depending on what you're doing and where you are, it may take a little bit more online campaigning, a bit more crowdfunding to get there, particularly the first time. But we believe they always exist. And they exist in funny places as well. So final thought, just again, is breaking out of locality. That what we've seen already is that people have cross-cutting interests. So some people are very focused on a particular place. I only support things, not even just in countries often, but like local towns or states. Other people, though, care about, say, climate. The climate people know that climate is one thing everywhere, and that you can often get more bang for your buck investing in climate tech startups in Africa than you can in Australia, if that's what you really care about. Clean oceans, it's all interconnected oceans. So depending on the thematics, if you're inspired by female founders, they're just as likely to be inspired by the story of an awesome female founder in Kenya as they are in New South Wales. So it's about it's about identifying what the enterprise needs, and then let's try and find people who are happy to come on that journey with them.
Great. Thanks so much, Tom. Okay, maybe I'll go to specific questions for each one, for Vula and for LendForGood. And I'll start maybe with a question for Vula on how do you kind of ensure or vet the kind of opportunities to ensure like recommendations remain kind of current and relevant, Kevin? And I think Jonathan also asked about like safety and security for SMEs. Like how do we reassure the security for those who do share their information on the platform?
Awesome. So on relevancy, it's quite interesting. So we work very closely with our ESO partners to give us feedback on the kind of funding opportunities that are generally suitable for their SMEs. So that's the first way. But more importantly, we actually allow you to choose which kind of funders you want to match to. So it's a simple selection. If you don't want this, you can actually add your own funder as well. Let's say you have a specific MasterCard is backing you, and you have a specific facility only for you. You just create it on there and match your SMEs like that. On the issue on security, we are based in the UK, and as you know, GDPR is extremely strict when it comes to data processors like us. So we have to be compliant. We have to be GDPR compliant, and we take that very seriously. All we do all day, every day is handle sensitive financial and operational data for a wide range of SMEs, including very large companies. So you can imagine the burden of data privacy that rests on us. It's quite serious, and we take it very seriously.
Awesome. And how do like intermediaries, the aggregators, as you mentioned, how do they access the platform? Like, do they get the same kind of purview with the SMEs? What does their access look like to Vula?
Yeah, this platform that I showed is actually the ESO platform.
Got
you're
it.
able to upload the SMEs that you have in this kind of format. Let's say you upload 10 at a time. Once they upload it, they'll now feature here. And you can now see all the details for that specific SME, which ones they've matched to. This is not accessible by the SMEs at all. So, but the SMEs that actually come to us directly and not through an aggregating partner can actually go to the website, and any of you can go to the website and sign up as an SME and check it out. However, we've found that that hasn't had much success, because the truth is the SMEs tend to provide poor quality data, and that's why we value the work that ESOs and accelerators and incubators do in ensuring quality and in ensuring we're actually presenting as the SME should be presented based on the funding opportunity. How you'd present to a bank is very different, even for the same SME, as how you'd present to a VC.
So the check and balance being the incubator.
Exactly.
Great. Thank you. And now to Tom. Maybe two kind of related questions, Tom. So something that I've heard from others who have used LendForGood. So we talked about Mitra before, and Mitra has been kind of an advocate for LendForGood and has been part of the Pollinate Impact Community for some time now. What kind of mechanisms help ensure that enterprises can access this debt financing in like generally founder friendly terms? I know that's something that a lot of people who I've talked to who've used LendForGood have said. And also, how do you kind of manage the risk, right? Like the repayment capacity that protects both the enterprise and the lenders.
So start with the last one first. Perhaps we're not trying to manage that risk. That's where we're trying to partner with people who are already cognizant of the risk. We're not doing any individual risk assessment deal by deal, because to do so, we'd have to get paid for that work. That's the whole issue. Part of our belief about due diligence is obviously due diligence is important, but there's plenty of it happening, and we think that due diligence is a bit like food, but there's plenty of food in the world. But the reason that people still go hungry is that food is often wasted and poorly distributed. And due diligence and knowledge and insights and connections and relationships are often wasted and poorly distributed. And I think that where they're often wasted is often at the intermediary layer, particularly early on. Human due diligence is probably as important for many things as financial due diligence, and that's the tricky one to get a checkbox on. You can easily see spreadsheets are easy to share, easy to understand. What's their turnover? How long have they been in business for, and so on. But is this person a bullshit? Excuse me. Are they completely upfront and honest? And do I trust them? And do I think they have the right kind of resilience to handle? That's kind of a human judgment call in many cases, and it becomes more important the earlier you go. And that's an expensive one to figure out for yourself. You have to spend time with people. You have to talk to people who know them. But that's what you guys often would already know. Someone might have had a relationship with you for several years already. So sorry, long-winded answer, bad habit of mine. But the quick answer is that is what we rely on you to do. And in terms of why why that creates confidence is because you are leveraging social capital and credibility, but you're also risking it. That will disappear if not used carefully. So if you're an accelerator program and you just kind of willy-nilly endorsed every graduate of the accelerator program anytime they wanted to raise debt on the platform, I suspect many of those would prove not to be the right fit, and your track record on the platform will be transparent. So again, that's not to say that people might not go. That's not to say that a lower success rate might put people off if it's great impact, if they understand that it's risk, that it's doing interesting and risky stuff. The fact that a certain number of them don't repay may not put them off, but it will put some people off, and it will get harder over time if that's what happens. But easier over. But to the other side is true too. Easier over time if you prove to be successful at that. And that's one of the things I'm passionate about. Is I think there's a lot of types of investment that are categorically considered high risk. Take Red Hat Impact. What they do is considered categorically high risk. It's relatively early stage lending, usually often unsecured, often in emerging economies. But they are good at it, dare I say. And so their overall success rate over time is 98% or 95% or, something very impressive. But that's kind of hard to understand. And so too many people get stuck by categories. And this is a chance to kind of surface that, in your context, in your industry, in your location, that we believe that you are very well placed to actually discern where the good opportunities for investment lie. And we'll be able to highlight that over time and build that community around what you're doing over time. And so what we're essentially trying to do is make sure with intermediaries that we are broadly on the same page. I mean, the one must-have that we do require, of course, in addition to it's only debt. I mean, that's a requirement. That's all we do. People are often surprised when I tell them we don't do equity as well. And I'm like, it's literally in the name. It's lending for good. But we do need to, every deal does need to be linked to a sustainable development goal. But even the question of like how much impact is impactful enough, that's context specific. As just one little example, we have a couple of partners in Australia who support Indigenous businesses. And one of them has a firm belief that every Indigenous business is a social change business, because the big picture social change we need is more business ownership and more economic empowerment in Indigenous communities. And so that means that, in other contexts, some of those businesses wouldn't fit the criteria for programs I run, because the model itself is not impactful. It's an Indigenous-owned hairdresser or petrol station or something, but in their context, that is still an impact. So we let them decide. We don't say, oh, no, that's not, we don't believe in hairdressers. Now, the second half of that equation, of course, is they have to cultivate and find and build and inspire a community of lenders and investors who also agree that that is sufficiently impactful for them.
Great. Thanks. Thank you, Tom. All right, I think we are winding down on time. So I'll just launch our feedback form for everybody in the room. This will help us know also who you'd like to connect with, whether that's Vula, LendForGood, or both. We'd be happy to start that conversation with you. Shami will connect you personally with Tom or Kevin, and then see how that'll work out from then on. But I wanted to leave with maybe one last question for Kevin and Tom. And something to think about for everybody in the room. Since both of you kind of handle at such a large scale in terms of the stakeholders that you deal with, what do you think are capabilities that incubators and accelerators should prioritize if they want to kind of better prepare their enterprises to access funding, whether that's on your platform or everywhere else, like learnings from your end in terms of this to kind of just prepare their enterprises to access funding, if not more easily, if that's not the right term, at least like make it a smoother process for them. Maybe I'll start with Kevin and then we'll end with Tom.
Awesome. I mean, one message would be what we did last year at the Pollinate Impact potluck. Ruod, do you remember? There was a lot of discussion around financial sustainability of ESOs. And we actually need to think of ways to actually make revenue. And that's why we designed this for that very reason. Reduce over-reliance or over-dependence on donor-funded programs and actually look towards commercial kind of investments as a way to increase the longevity of your ESO. So one thing to look out for is we're very heavy on high quality over quantity any day, all right? If your data room is not in a position that you would present to a funder, you shouldn't present to us, right? We have the same kind of quality requirements, more so actually than most funders here. So my word would be for anybody reaching out to us, we need companies that are actually solid. We're not talking about revenue here or how well established the SME is, but quality in terms of presentation of data, in terms of organization.
Thank you. Thanks, Kevin. And Tom.
I think, one of the key things when looking at any kind of crowdfunding platform is that you need to decide what you're trying to do first before you decide how you're trying to do it. And I think what you tend to see with crowdfunding platforms, and this is probably true for any funding source, is people look at it and they go, how can I do that? And it's a little bit like, when I was a digital communications manager in the early stage of social media, people would say, how do we use Twitter? And I would always say, Twitter, that's the wrong question. Twitter needs to be the answer to the question, not the question. So the question needs to be, how can we share more real-time updates with our activists? How can we better connect with and influence journalists? Those sorts of questions, Twitter would be a good answer for them. And so it's a similar thing with crowdfunding. It's why, again, I really respect and believe in, and obviously am part of the work of intermediaries, because those are hard questions often for enterprises even to figure out for themselves what kind of capital is right for me. And so it's so important to have that guidance. And obviously debt is a particular instrument that is really good for some, like really appropriate for some things, and, you know, without non-dilutionary growth capital, so on, and really inappropriate for other stages when the risk parameters are different or what's been done in a different context. So, you know, my one thing is to get really clear on what's right for the enterprise first, and then let's figure out how to get it. But in doing that, I think there's a risk for all of us sometimes that we have a certain learned obsolescence, again, that our thinking always does work backwards from traditional investing sources. And we go, what do they need, and how do we get these guys to line up with that? And I just encourage all of us to kind of remember who we're here for, which is to work for the enterprises and to help them grow on behalf of our communities. And so it's sometimes easy to get sucked into kind of the business as usual frames and thinking when you're interacting with or standing right on the kind of edge of with enterprises, the kind of financial system. I think let's all stay focused on the needs of the enterprises, and then be able to, you know, check how they line up with the massive database on places level, and then potentially look at how we can go looking for those potential investors and cultivate that community together through a platform like ours.
Great, thank you. Thank you again to Tom and Kevin, and of course Cam, for sharing their time with us today and sharing their platforms. I'm just waiting for a few more to answer the feedback form so that we know who you'd like to be connected with, but we are so excited to see so much excitement through the questions, and just in terms of people who are here today that want to learn more about how to kind of get more accessible capital, and also to just have this conversation together. So again, thanks to Tom and Kevin, and thanks to all of you for coming today. I hope you have a great rest of your day, and we'll see you on our next session. Thank you.